In fact, the most recent quarter shows a record number of software developers employed. Now, that may change, but it's important to recognize that the productivity of software developers has been going up for 20 years. And I think the effect of AI is not so much to replace software developers, but to allow them to do more and produce better quality products.
Welcome to Fixed and Floating, the credit podcast. My name is Josef Pschorn, and in each episode we explore the forces shaping credit markets. Today we are doing something a little bit different. My guest isn't a bond trader or a credit analyst. He's an economist who has spent decades studying how technology reshapes industries and the companies within them. His research goes right to the heart of what credit investors care about. Which companies can sustain their cash flows, which ones are building real moats, and which ones are about to be disrupted. I'm very pleased to welcome James Bessen. Jim, welcome to the show.
Glad to be here. Thanks for having me.
Jim, you're a very unusual combination, an economist, a legal scholar, and a former software CEO. Before we get into your research, how did building and running a software company shape the way you think about technology and corporate power?
So while I was running the company, I was, very curious about what I'd read about or learned about technology in the classroom, about innovation, and things seemed very different in a way. There really weren't patents for software, and we had learned, for instance, that patents were essential for innovation to take place, and yet here was this very innovative industry without patents. And that's what initially got me doing some economics research after the company was sold. But there were a bunch of other things. One was simply, you have a picture from the economics textbooks or whatever, that some inventor gets an idea and that's it. Let's start a company and it builds, and it's just so much more difficult than that. It takes a long time to adapt an idea, to develop it, to work out all the different ramifications of it, if you're writing software, to debug it, to really get it to adapt to the customers. There's a big learning curve, both for you, the creator, and for the customers. And that's, the development of all of that knowledge, that learning by doing, is really a critical component of what makes some companies successful and what gives them, some protection against competition, even if they don't have patents.
Your central argument in your book, The New Goliath, is that large firms are using proprietary software systems to build durable market dominance in ways that slow down creative destruction. High-yield credit investors usually focus on smaller, more levered companies, which are to some extent also constrained in their ability to invest in IT. Could you walk us through the mechanisms? How exactly does proprietary IT translate into market power?
Maybe an example would be helpful. So Walmart has this tremendous information technology system, and they've had it for decades now, and it's been developed and it continues to grow. But it's something that tracks very closely every cash register in every store and every product as it moves through the system from manufacturer to just warehouses to stores. So it's got a picture of what is selling at any time, and it's got great tools for adapting what's being delivered to each store over time. And that allows it to, number one, stock its stores with much bigger selection, many more products than its competitors. It's able to respond very quickly to changes in demand, fads or fashions, or as things become popular or not popular. And so it means that a consumer going with a choice to go to Walmart or go to somewhere else may tend more often to go to Walmart because they're more likely to find what they want and more likely to find things that meet their taste. And that's a capability that rivals are not going to have unless they've built up that base of not only software but an entire organization which understands that software and how to use it, and methods for using it, so it becomes very agile.
But what you are saying is basically that Walmart is able to turn over its inventory way more often than competitors, right?
That's one measurement of its success.
Okay, understood. What do you think is the key differentiation between what Walmart was able to accomplish versus what, let's say, Kmart or also Sears could not? And if I would apply this analogy to current times, also thinking about somebody like a Dollar General is not able to do.
They're not able to offer as big a selection. Dollar General has, maybe 10,000 SKUs in a store, 20,000, whereas Walmart's got stores with 100,000. It's a much bigger selection. It's got other advantages, and Walmart can adapt and change its selection. And at the same time, it's able to deliver things to the store at low prices. So that's an advantage that is difficult for the others to meet. A store like Dollar General may, its strategy is more one of having many small stores distributed over the landscape so that, in rural areas, if somebody doesn't want to drive, there's going to be a Walmart nearby, but maybe there's going to be a Dollar General closer. So that's in some way their advantage, but it's limiting in a way.
You also show that the firms investing most heavily in proprietary software are seeing rising markups and declining market entry. But it seems to be mostly to the advantage of the larger companies, not to the smaller ones, right?
That's right. Small. So a small company, I think of the Walmart strategy, it's not something that's going to work for a small retailer, a niche retailer. They may be able to develop tools that work for their niche, but it's just not the same ball game.
So you would say some of the advantages only accrete to larger retailers or larger firms in general. So
Right.
You need a certain threshold under which it just does not make sense to develop that. So I think that there is this saying that you need $1 billion to develop a car. I think that's a similar analogy to here. So you need a certain size. A similar analogy is probably like the largest banks in the US. They also are able to use proprietary software to really tailor their credit offering
Right.
and have developed a significant advantage over smaller competitors. What are those larger banks doing with software those smaller banks cannot do?
So they're able to access much more data on customers. So it becomes they have so much more data, so many more customers. They can look for patterns and do it in a way where it just would not be scale efficient for a smaller bank to do. There may be third-party vendors who can supply some of that, but the thing is you can analyze what sort of credit offerings are going to be the best thing for a customer who has a track record of how much do they tend to borrow, how long does it take them to pay off their credit card balances and that sort of thing. And you're only going to see that in a statistically significant way with a large pool, but they're able to do that, and so they're able to tailor home equity lines or credit cards for the specific needs that work best for particular customers, individual customers. So this whole thing is about tailoring offerings to meet the idiosyncratic needs of different consumers, whether it's a Walmart customer looking for, sporting goods, or whether it's somebody looking for a credit card that offers just the features they need or want.
So you would also rebuke some of the claims that, let's say, financing companies are able to obtain some of the data elsewhere, whereas, like, let's say a JP Morgan has always the advantage that they have so much data and information about the customer or client in-house, which, let's say, another alternative, let's say buy now, pay later provider can rarely achieve.
That's right. Yeah. And so there's been some battles. So there are FinTech companies, of course, which are trying to get the data in a way to do some of those things themselves. And at least in the US, this is less so in Europe, but there's a battle between and there has been, between the FinTech companies who really have obstacles to getting that data. It's getting better for them in the last few years, but it's taken a long, long time.
Yeah. So what you are referring to, that it's tougher for people to get the data out of banks or other institutions.
Even on their own accounts. So
Yeah.
in other words, if I want to do something with my data, it's
Yeah.
hard, and get it into a FinTech product.
Yeah.
I may be blocked from doing that
Yeah.
directly from the bank.
Yeah. But that could be a thing that people will have more authority about their data, their personal data, and can then monetize that in a better
Yeah.
way. So that's
Yeah.
at some point a potential thing.
Yeah.
I think your research has also shown that software investments help dominant firms build real moats that prevent displacement. As a credit analyst, when I see a company increasing OPEX or CAPEX on tech investment, how do I assess whether they are building a real moat, or somebody at the top, versus just a challenger who is trying to compete? I think we are here pretty much at the same argument we have done before. Somebody at the top is probably setting himself apart, versus somebody who is a challenger has a harder time really to compete and is just investing to keep up. Could you share some thoughts here how to develop a mental model around these thoughts?
Well, the moat comes from delivery. It's not in general from artificial restrictions on the market, artificial barriers to entry. So, for instance, if Walmart had a patent on
Yeah.
its technology that could keep out any other company, Target, or Amazon, that would be a barrier to entry. But the reality is you can't really patent a lot of this stuff.
Yeah.
And the technology is much more than just what the patent would cover. It's about the organization and the knowledge that the people in that organization have and how they act on it. So but the thing is, it's a real, where Walmart gets its advantage is because it's delivering for the customer. It's delivering real benefits, and that's the advantage. Not that it's so much blocking the competitors. It's the competitors have obstacles to developing the kind of systems and the kind of capabilities that Walmart has, or the large banks have.
So you would say that the big advantage arises from the companies which can build software systems which achieve additional value for the customer, like Amazon being able to deliver same-day delivery, or let's say a JP Morgan who is able to price up a loan within seconds. So these are basically the things which set themselves apart and basically increase their reach and also they value for customers.
Yeah, exactly.
Another key theme is disruption risk. So I think a lot of credit investors usually think about the left tail. So what happens if my technology gets disrupted or my business not relevant anymore? Your research actually shows something counterintuitive. So that technology is at the moment slowing creative destruction in many industries. Is disruption risk overstated generally for the large dominant firms?
So yeah, I'd be a little careful about that. I think technology is actually enhancing disruption overall, in terms of, or it's enhancing rivalry. It's enhancing, if a company comes onto the market, there's a greater risk that somebody else is going to develop something that may make it obsolete, just because there's so many more companies investing so much more in R&D and innovating. But nevertheless, at the same time, the largest companies who have built these large systems have had less disruption risk specifically. They're, a company that we measured it, for instance, a company that's in the top four of its industry is less likely to fall out of the top four today than it was 20 years ago.
Could you walk us through a case where a dominant firm's technology, the moat of the company has actually eroded? So I'm thinking about companies like IBM's mainframe, Nokia, or Blockbuster, like where the incumbent has built strong, powerful proprietary systems, but still got displaced. What did that transition look like operationally?
Well, the first off, it tends to be slow. I mean, think about it. IBM was king in the 1960s. In the 1970s in the 1970s, you had mini computers come along. In the 1980s, personal computers come along, and each of those took a whack out of IBM's mainframe business. IBM still continued to grow and still continued to be profitable because it was doing PCs. It had its own IBM PC. It played a key role in the PC industry. It had its own mini computers, although they weren't nearly as successful. But it wasn't until the 2000s that the hits started adding up, and from 2010 on, IBM's had declining revenue. You see, Nokia, I think, also hung on for a long time. I mean, Nokia's effectively become, it's not really a phone company anymore. It's more of a patent troll. It's just, it has those patents from the past, and it's able to extract rents on those. But so it's not, there may be dramatic events where all of a sudden, boom, the company's out, but those dramatic events are built up over long periods of time.
But we are here talking more about the existence of a company and not talking about the market value of a company, right? The market value of a company could be challenged much earlier once growth got basically scaled
I
back.
mean, if you're talking about the market value being
Yeah.
how stock investors see the company, if they understand what's going on with the technology and where it's going, they may drive the market value down. On the other hand, I think investors are sometimes way off the mark on their understanding of how the technology is going to evolve, and they too tend to hang with the dominant company for a long period of time. So I think, for instance, IBM investors were hanging with the company for a long period of time, even though its technology was getting weaker and weaker.
Your 2025 paper looks at what happens to workers at firms that automate. What does automation do to a firm's cost structure and operating leverage?
Automation tends to substitute machines for humans. Now, at the same time, it may add to the number of humans. So it may, it may mean that labor is a smaller share of the cost structure of the firm, but the firm also grows so that the amount of labor may increase. And people often assume that automation means a loss of jobs, and that's simply not true. It can be an increase in jobs.
But it's not a straight line. So
not at all, not at all. So, I looked historically at, 19th century industries that automated, textiles, steel manufacturing. And what you see, like textiles, as automation moved along, and this is serious automation, the amount of machinery per human grew, but the number of humans also grew. So there was tremendous growth in the number of textile workers for 100 years. And only in the mid 20th century did it start really declining. In the US, I'm talking about. Some of that was things going overseas, but a lot of it was simply demand driven. So, the story was with textiles. At the beginning of the 19th century, textiles were very expensive. Clothes were expensive. So people had very few clothes, very little clothing. As the automation proceeded, the cost of the cloth went down, the cost of clothing went down, and people started buying a lot more of it. So they bought so much more, demand was elastic. They bought so much more that even though there was less labor per yard of cloth, the total number of cloth yards, created grew so rapidly that employment went up. So it grew several 100,000 number of textile workers. And only when, the mid 20th century, you come along and, well, at that point, people have lots of clothing. Their closets are full. They've got cloth being used for upholsteries and all sorts of things. Automation is still chugging along, making it less expensive, but now the drop in price doesn't elicit an elastic response. It doesn't, bring up demand so much. So no, there is still growth in demand as the price goes down, but it's less than the loss of the loss of jobs that comes about because cost less labor is needed per yard.
In our pre-call, you also mentioned something really interesting. You mentioned that we are currently, or in the US, there are currently the highest number of software engineers employed ever. And
Right.
also given the impact, the potential impact of AI, everybody's looking around and thinking, all those software engineers going to be displaced anytime soon, right? And could have been already replaced last year, but we still see that increase. Could you also shed a bit light on that development?
What I think is going to happen. So, there's some people who are saying. So we've had Chat GPT and the Copilot products from Microsoft that have been now being used by developers for 3 years, some 3 years now, and there are some people claiming that. It's here, we're losing software jobs, there are these layoffs, they're not hiring new software developers. But in fact, the most recent quarter shows a record number of software developers employed. Now that may change, but it's important to recognize that the productivity of software developers has been going up for 20 years. If you look at the deflated output of software being produced divided by the number of software developers, it's going up maybe 5% a year. And while that's been going on, the number of software developers hasn't decreased. It's gone up about 3% a year.
Yeah.
And so that looks to me very much like the textile workers. As things become cheaper, or I think in this case, better quality, so the quality of software has gone way up. So people are willing to spend more for it. And it may take fewer developers to produce a certain level of quality, but we're just seeing rising demand because the quality is getting better. And I think with AI, it may continue to be the same sort of thing, that the effect of AI is not so much to replace software developers, but to allow them to do more and produce better quality products. It may
Yeah.
change. I'm not gonna bet my house on it, but it's the evidence so far isn't that. I'm watching it closely, but there's no evidence of it so far.
I think in your book Learning by Doing, you did show that productivity gains from new technology often take decades to materialize. In the terms of thinking about all the capex investments, are those companies front-loading costs without near-term cash flow support, or how can we think about what's happening with all this investment?
The AI investment.
Yeah.
So there have been a number of tests and measurements done which show that there are real productivity gains so far. There was a very good study done of Microsoft Copilot and found that on average, software developers are 26% more productive.
Yeah.
That's real. That doesn't seem to be affecting the employment of software developers, which is the thing I just. But I think there's another thing going on here, which is we're seeing these huge investments in, well, people are calling it infrastructure, but in terms of the capability of running large language models, data centers. So a couple things about that. These investments are, the majority of the investment is in software and R&D. It's being called infrastructure, but in a way it's very different from like the dot-com boom. So in the dot-com boom, companies poured a lot of money into fiber optic cable or data servers. Those are things that last a long time. Data servers tend to last around 10 years in use. Fiber optic cable, maybe, 20, 30 years, much longer. So what happened in the dot-com boom, things got ahead of demand. They had built this capacity. There wasn't the cash flow to support it. There was a recession in part because of a pullback, but it was pretty mild because, in fact, in 5 or 10 years, those servers and that fiber optic cable were actually put back into use. So it wasn't such a big problem. Today, you've got, first off, investment on a massive scale. I've seen some figures that some of this may be companies trying to beat out their rivals, they're viewing it as sort of a winner-take-all market. But if in order for all of the investment in AI data centers to pay off, there would have to be just phenomenal market that nobody's really predicting. So Dario Amodei, the CEO of Anthropic, has some nice discussions of this, that it's not going to support all of them. But I think the risk factor here is very different. If you think of it as infrastructure, like the dot-com boom, well, okay, so maybe we're ahead of ourselves a little bit. The problem is here the investments are much more short-lived. The majority is software and R&D, and it's R&D which is very short-lived. The frontier model is at the frontier only 2 months on average, right? So the latest model that gets developed isn't going to be around in 5 or 10 years. It's going to be worthless investment. There are investments in physical buildings. There are investments in GPU chips. I'm told that GPU chips can last a while, but when they're being used for training models, they may only last a couple years on average. So you're looking at a lot of that investment's not going to be around. So if we do hit a wall, if there is a break, if there is a recession, the risks may be much greater for the investors of those assets.
Your historical work shows technology adoption creating winners and losers in unpredictable ways. The telecom bubble is the obvious example. How can we think about the technology investment currently underway and what it means for the winners and losers coming out of this?
That's very tough because it's so unpredictable. I tend to go along with Amodei and this idea that they're not all going to be winners. I also agree with the analysis that the winners aren't going to be just the chat agents. The winners are going to be people who have taken the technology and adapted it to real needs. Now, so one of the needs is helping software developers. There's a clear market for that. The products that do that well, I think they're going to get better and better. There's a real, there's a real possibility of profitability. They're certainly not there yet, but that can be envisioned. Some of the other ideas that have been thrown around for uses of AI, I'm much more skeptical. And I'm sure I'm going to be wrong about some of my hunches, but just it's just not clear that there are really big profit opportunities in many of the things that people are throwing AI at.
Which are you thinking about?
Well, you read about all sorts of things people are doing with AI, and so many of them, I scratch my head and say, how's anybody going to make money with that? There's some where, okay, maybe there's some money to be made. So, for instance, call centers. My personal experience is that call centers have gotten way worse in the last couple of years, and I think that's because of implementations of poor AI. Now, maybe the AI can get a lot better. I think partly it's about how it's being used. I think the best organizations use the call center technology, the AI. They use the AI really to support and enhance the human staff, whereas I think the way it often gets used, you're put through a maze when you call a company and try to get the damn AI to give you the answer you want. If it's one of those standard things like, what's the balance of my account? Well, great, you can get that. But we've had that with phone messaging for years now. But the more complicated questions, the AI isn't necessarily going to be very helpful. It's just too often doesn't answer the questions. Then you end up spending 10 minutes on the phone before you can get to a human representative who can answer your question quickly. But I guess my point is I should relate this to your question. It's not clear to me that there's a huge financial upside in that unless things change sharply.
What you're saying as well is, I guess, that the companies which have the large data lakes like a JP Morgan would also benefit the most, given that they can train the models on just just much larger swath of data, whereas like smaller ones, which also don't have the data infrastructure in place. I think that's also like a very, very big barrier. Can't compete at such a high level.
Yeah, I think that's right. I mean, you're seeing some large companies, financial companies, for instance, just turning AI onto their proprietary information about different sorts of instruments, different customer needs, different customer behaviors, and the they may not be able to fully automate the process of answering customer questions. I think people are so focused on automation that there's tendency to shoot for what's an unreasonable or unrealistic goal sometimes. But they're able to do a lot more of it, and that's important. Not just being able to, the AI is important not to just be able to fully answer all customer questions, but to put at the fingertips of the human representatives much better information that they've had in the past. That's where I think it works well. But yeah, it may be harder for a smaller company without the resources to do that.
Your research also has shown that industry concentration has increased dramatically since the mid 90s, around 2000, I believe. Given that AI has made coding so much more accessible and also way cheaper, how do you think about the potential of smaller companies to compete and to reduce industry competition again?
So I'm not pessimistic about that. Smaller companies can do a couple things. They can use this technology to produce code, and if they've got good ideas, so that they can make useful products, they can get a leg up. They may still have significant headwinds in terms of working in any particular market, or they may have an exit strategy which sees themselves as being bought out, and so they may be able to. It may still be difficult for them to go to an IPO, but they may still be, have a private equity exit or corporate exit. Where the large companies may buy them, and so there's still possibilities for smaller companies to come in, introduce new products, up the competition at least temporarily, and that's not a bad thing. By the way, there's more recent research which finds that industry concentration has been going up for 100 years. There's this slow, as our economy matures, I think is the interpretation, industries have tended to become more and more dominated by.
You also have very interesting thoughts on the topic of antitrust. I think you have argued that instead of breaking up large tech-enabled firms, we should encourage them to share technology and data. I think one great example you shared is that I think on the one hand side, IBM opened the market for software, and also I think GM opened the market for the transmission engine. So if regulators force data sharing or interoperability, what happens to moats in general, or how do you think about this conundrum?
So it's all depends on how it's managed. So another example is Amazon and AWS, the cloud. So Amazon had developed its own proprietary capabilities for running large websites with lots of transactions. It's not a simple thing to do. And they had lots of customers who wanted to tap into those capabilities. Amazon realized they've got a tremendous moat, but they could actually license those capabilities for a fee to other companies, including small companies, which is what they did. They made AWS available. It's for a fee. It turned out to be hugely profitable for Amazon. AWS is not the only cloud provider, but it's got so many different products and such a large support, what economists call network effects. It's got AWS has a moat or a substantial moat. So although there other companies have come along, Amazon is still the number one cloud provider in the world. So a lot of it is how you manage it and how you think about it. But it's often very difficult to think about opening up. In the IBM story, IBM executives had taken two different attempts to study whether they could. This was about unbundling. So back in the 60s, when you bought a computer from IBM, you also bought the software. It was all a package deal. There weren't many third-party vendors, and IBM didn't encourage them. So unbundling was going to be, allow third parties to produce software for the IBM computers. They clearly had an advantage in maintaining control. There was a moat there. Their rival computer companies couldn't tap into the base of software that was on the IBM. The Justice Department was threatening to sue them for antitrust, and so in response to that, they decided to open up. And again, that turned out to be hugely profitable. They could not have anticipated demand because, what it did was it meant that there were just scads of third-party software developers all of a sudden. They were developing software for IBM. They were developing software for IBM's computer rivals also, but the benefit was accrued to IBM much more than it did to the rivals. And again, it may have contributed to the decline of IBM in the long run, but as long as IBM was participating actively in the software space itself, as long as it was, providing good value on the computer side, I think it probably benefited them. Well, I know it benefited them in terms of profits, but even in the long run, strategic position. Yeah.
Is there a scenario where regulation aimed at reducing market competition actually would hamper the larger players? Let's say, I think that the poster child is, for example, like Google.
Yeah, it all depends on the details, I think. That's the, so there's no doubt that Amazon became more dominant in some ways after it opened up. There's no doubt that IBM became more dominant in some ways after it opened up. So while the intention may have been it did encourage competition. It's not clear. I think the regulatory authorities and in most of the economics literature focuses on competition as product market competition, and I think technology competition often works in very different ways, so that you have a lot of technological rivalry going on in some markets where there may not be a whole lot of product market rivalry. Regulatory solutions, regulations that are seen to, designed or intended to increase competition. They may increase product market competition, but not necessarily technological competition.
I think you also had a very good example in your book where you talked about the difficulties for regulators to understand the complexity of VW's, how to put it, novelty in disguising their ability to So how can you think about the complexity embedded in all these in software in general, and also apply to counter regulation?
Yeah, well, I think software makes a lot of regulation difficult. Yeah, so the example was uh, just a few, relatively small number of programmers was used by Volkswagen to create a cheat on the emissions test. So the the car could detect when it was undergoing an emissions test, and then all of a sudden reduce its emissions, right? Its bad emissions. And this was relatively simple for them to do. It was relatively difficult to detect. And it basically meant that they were putting out cars that were emitting bad pollutants at 10 or 20 times the legal level. So that was huge. But it's the complexity is also one of the things. I mean, you look in the 2008 banking crisis, where there were complex mortgages that you had all sorts of banks, including very smart people, investing billions and billions of dollars in instruments that were just garbage, but they were obscured because of complexity that was enabled by software. So it's a real problem, and I'm not sure anybody has a very good solution.
If you take a step back, if you had to evaluate a company's technology investment, and whether it is actually protecting or endangering its ability to grow profitably or even just survive, like some companies, they need to invest just to survive. What would you look at?
Yeah, I mean, I think the basic things to look at is, does it have profit-making potential? Is it going to deliver some new capabilities that customers value so that it can make profits? Maybe not today, maybe in the near future, but that's the key thing. It's often hard to evaluate, which is why there's risk. But yeah, I mean, that's what I think what you need to focus on.
And it's probably also not that easy to understand and also to measure if you compare it to, let's say, a capex investment in a steel plant where it's pretty clear what you're getting out of.
Right. Yeah, I mean, look at these AI investments where, they're losing tons of money. They're not anywhere near profit, or some of them aren't. And it's just not clear, are they going to get profitable? Part of their calculation is that costs will come down. Well, it's hard to predict how much costs are coming down. It, there's just a lot of uncertainty.
What would you say is the most important thing that the general public is getting currently wrong about technology and corporate power?
Well, I think the thing that inflames the public most right now is this fear of automation. And this has been going on for decades and decades, and even back into the 19th century. Automation simply has not been historically an overall negative thing for the economy and for the general public. Is it possible that this time is different? Yeah, but are we seeing the signs that it's so different to date? No. We have to watch it. But I think, there's just so much hype about the new technology. There's so much talk about with people writing with great assertiveness that now we're finally seeing the technology replacing humans. There's going to be no jobs. Computers are going to be able to do everything that humans do in a next year. That just seems fairly far removed from reality that I can tell.
Jim, this has been a fantastic and fascinating conversation. Where can listeners find more of your research?
Well, I have 3 books. There are working papers, and I do write occasionally in general interest publications. You can find some of those things at the website of my organization, Technology and Policy Research Initiative, at bu.edu.
Jim, thank you so much for coming on Fixed and Floating. And also thanks to everybody watching and listening. If you enjoyed this episode, please follow or subscribe wherever you get your podcasts, and see you next time.